Hey, in this video, we're going to use some simple indicators to mimic strategy used by professionals to trend trade, scalp, position trade, and swing trade all over the place. We're going to use a super trend and two Bollinger Bands to construct a methodology similar to Hurst cycling or my own TQFM. A lot of my work is based on the work of Hurst, who was a technician who did a lot of work around cycling and price action in the 70s, 80s, and 90s. You can find his equations all over TradingView. We're going to build our own using simple scripts provided by TradingView. In this case, namely, so what we're going to do here today is I'm going to show you how it works, the settings for the indicators, talk you quickly through the methodology, and then we're going to run a 100 sample backtest to see how it performs. So you can learn a little bit more about the market to make yourself a better trader and investor. So let's get into it. So the setup for this indicator is pretty simple and yet kind of complicated. So the market's just a series of trends and waves, pushes and momentum, exhales, inhales, that sort of thing. We can start looking at this by turning these off and looking at these one at a time. So let's take a big Bollinger Band here. The settings on my big Bollinger Band, I usually like to just keep it at 100. And we're just going to run one standard deviation because I want to see when it's moved away from the line and by how much. So basically on this now we have 4 zones that price can be in. Let's go throw on a second Bollinger Band. This one's much shorter and it kind of reciprocates around and bounces off the big one. And the settings for this one are going to be 1/5. So I go about 20 and a standard deviation of 1. And that gives you something that looks like this, where you have one Bollinger Band popping out from behind the other one. And to do that, you want to set the smaller one to be behind the bigger one visually. So bring the big one to the front and then make sure that price is on front of, that the price bars are in front of all of that. So now we don't even have 4 zones. We have 4 zones, and then when it gets outside into these 2 extra zones, we have additional zones. So we don't care about these zones when it's inside of here, but we care about it when it's outside of here. So wouldn't a great trade be, we know this is big one's in an uptrend. And now we have everything separated into zones. Assuming price will continue to do as it does until something changes, just buy it when it enters that most bullish zone. And you kind of hold it until it starts getting into the less bullish zones. And you can actually label this very mathematically. 1, 2, 3, 4, 5, 6, 7, and 8. That sort of idea. And then we can use that to just throw on a quick little trend reader to help us out. This is just a super trend. We're just going to set it to 20 and 2. If that makes sense. So I want the super trend let's look at both of these. I want the super trend to be triggered when it crosses here. I don't want it to get upset and flip back over until it crosses the other side. So see, the super trend is basically telling us which area this broke out of last, to the upside or to the downside. And when we combined all of those and we sandwich the super trend in between the big Bollinger Band and little Bollinger Band, we get something that looks like this. So how would you use something that looks like this? And why would that make sense? Well, like I said, this is all under the understanding the market tends to do as it does, or as it is doing, until it changes its mind. And this is just a very mathematically objective way to measure that. So the market's going up, we can measure that with the advancing large Bollinger Band. And then inside of that larger going up, we want to take the strongest points. So mathematically speaking, that's going to be when price breaks into that first zone. So a very easy trade would be buying when price breaks into that first zone, and then selling when price gets into zone 3. So we come in here, pops up, you can buy that. A stop would be, well, the stop's when the green thing goes away and turns red. So that's your stop. You're gonna carry this up until it hits there. So I made about $1 there. And then on the downside, here it comes out here, flips red. You can short that, and you can take it all the way till it turns green down there. It's a solid trade. And the most important part about this is it's very mathematically objective and consistent. So with the explanation out of the way, I'm going to go ahead and start backtesting. Hey guys, I'm back, and we had a successful backtest, and it was nice and fun because it's something that I'm kind of proud of. So, the B-band scalp formed admirably. We started with $5,000. We took 100 trades. We won 54 trades. We lost 46. That means we only won 54%. If you do a million of these, it's probably going to be about 50% even. But we made some money, a good bit of money. So how do we do that? Well, our average win was about 2.3 times the size of our average loss. You can see in the chart, we had lots of bigger wins and lots of little losses. And that seems to be the tendency of these sorts of strategies, where they tend to get good chunks out of very strong trends and otherwise just take little boops back and forth, whether it's like $2 up or like $1.90 down or whatever it is, and then sometimes they have the big wins. So anyways, I hope you guys enjoyed that, learned something about the market, and help you become a better trader and investor. Thanks for watching. Make sure to check out my other related content. If you like this, you'll like that too, and subscribe to my channel for more. Have a great night. Bye.